Howdy there, folks. Welcome into today's video. It's a buy one, get one free in this one here today. Two videos for me to react to. First one up here is from a few hours ago. Mr. Tom Lee's out and about. Tom Lee giving his opinions and perspectives on inflation, on where the market's headed, what's going on in the stock market, and things like that. Which, by the way, Tom Lee's looking pretty good because he said it would be a kind of a painful 2 to 3 week span. And he said that about 2.5 weeks ago. And so far, the market's definitely shown some real weakness in countless stocks. And so I got to give him credit. He's actually been pretty dang on, not just with kind of this year in general, but like even like these short-term things of like the market's going to be up this week. I'm like, wow, it's been a let's call it a very good year for Tom Lee. Okay. Then I want to react to this one from yesterday. Okay. Be patient in this market, says Chris Atumi. And so I want to hear his perspective and kind of share my perspective on that and react to that one. So appreciate y'all being here as always. Thanks so much for being subscribed. We're at a new all-time high subscribers, 33,600 plus, I believe, now on the channel. So I appreciate every single person subscribed to the channel. Thanks for being here, guys. And also pin comment down there if you're looking to apply to join my private group. Get in there with myself and all the other members. Then check out the pin comment down there. You can fill out an application. We can see if you're a good fit. Alrighty, let's get into it.
Strat, Global Advisors, and a CNBC contributor. Tom, you're correctly bullish, and then more recently for August, you thought that maybe we'd take a breather. I don't know if it's more than that. Maybe 10% pullback, maybe not, but that's kind of playing out as well.
That's right. It's August is generally a tricky month historically, especially when the markets are strong through July. It does seem like the weakness is a lot more pronounced, especially because yields are up and the dollar's strong, and I think people are maybe fretting a bit about China too. So I think later this month, starting with the FOMC minutes, and then we get Jackson Hole, and then at the end of the month we get the inflation data, the PCE. Maybe that's when markets start to feel better. So maybe we could finish August a little better than we started. But you're right, maybe it could be.
That's a decent pullback, 5% for the Nasdaq. Nothing crazy, obviously, but that's a decent pullback. That's the type of pullbacks you get a lot of times in bull markets. You'll get like 5 to 10% type pullbacks in the indexes in a matter of a few weeks to maybe a month or two. By the way, let's check and see what's going on in the market here today. Oh boy, here we go. What do we got going on here? Looks like a little more to the red side when it comes to big tech here today, with AMD showing the big weakness out of everything, but even these green ones are barely green. They're barely clinging on. If we go ahead, pull up, a lot of these stocks are kind of showing Red Dead Redemption here today. Target's the one winner. Honest, hey, Honest is a winner. Palantir is switching into gear a little bit. Might have something coming in regards to Palantir soon. And PayPal's break even. We'll take it. We'll take it. PayPal break even, baby. That's all we need. All right, guys. Let's get back into this.
It could be deeper.
Your call was based on the trend in inflation, which continued in the week that you made the call. It was based on the inflation numbers that were coming that week, which were friendly. They were soft. And you still, but the economy, meantime, has been much stronger than most people thought, and now it's going to be no landing or soft landing, or people are thinking the narrative changed. But you still feel that inflation is going to show a downward trend. In the PCE, what'd you say, 0.2%?
Yeah, that's right. I think core inflation which came in at 0.16 last month. That's still reflecting an elevated housing number. Shelters running at close to 8%. That's going to start to cool, and there's a lot more downside in used car prices. And then core services, which is the rest of that piece, it's actually been cooling because that was kind of been pushed up by vehicle insurance and auto repair, which are going to start to fade. So I think inflation is on a glide path towards sub 3, sub 2 by the middle of next year. That's what I think.
Sub 2?
I think we could print something pretty low, because when shelter goes to 0, then you could have core at 0. I mean, you could have some 0 month over month, or even negative month over month for a bit.
It's weird. That's like a shocker. Well, we back out energy.
Yes, that's right.
That helps, because energy is, but then it filters through to other things where it does seem to can be reflected, even though you back it out. Right?
That's right, because the diesel filters through as a surcharge. I think the Fed will be alarmed a little bit by energy, but they will treat that differently than something sticky. Because, energy can sometimes be idiosyncratic, the rises and falls.
So under 2%. So the highs by the end of the year still in your playbook?
Yes.
All-time highs in the S&P by the end of the year.
Yes, I think as bad as August is, maybe even if we're down 5-8% in August, there's $5.5 trillion of cash on the sidelines. I do think a lot of people still think the Fed is going to hike.
All right, hold on. He mentions about obviously, massive amounts of cash, $5.5 trillion of cash on the sidelines, right? Very important. And I pointed this out in a video. I don't think it was here on the reaction channel. I think it was a main channel video. I pointed this out, okay? And if you look back prior to the great financial crisis, cash piled up, actually. Money market funds, piled up. People just keeping money on the sideline piled up, actually, going into 2008. Didn't save the market. Didn't save the market at all. Obviously, all the indexes fell 50+%. And so this is something to keep in mind, that just because there's all this sideline money does not mean if you were to actually get into a recession, and especially if that recession was to be a deep one, doesn't mean magically that money is going to help save the market. Okay? So I think that's very important everybody understands that point there, because, you could have thought that in the great financial crisis, and it never saved the market at all.
But if they do only one more, I think the market can absorb that. And then, of course, growth has been strengthening. And look at S&P earnings. Ex energy, it was up almost 3% in the quarter, the first time in 6 quarters. So I think you have an earnings recovery, Fed maybe slowing, interest rates could stabilize, and then the cash gets put to work.
Can we do all this with China falling out of bed?
We do have to watch that carefully, because on the one hand, China's weakness exports deflation, which is kind of gives us 2024 the idea that producer price and
something good for companies is a lot of companies are seeing their profitability skyrocket right now, not even on strong revenues. Target's a perfect example. Look at Target's numbers. I did a breakdown inside the private group here today in regards to Target numbers. Profitability skyrocketing, like astronomically for Target, with extremely weak revenue numbers on the top line. And so you got a very interesting dynamic where top line's not strong, but bottom lines are skyrocketing for these companies, because obviously what they went through last year, almost every single company was caught off guard in a major way by the inflation that was felt, right? And then obviously for retailers, they had way too much inventory as well.
Season CPI could be softer, right? But you don't want the second largest economy to fall into a recession or a depression or a recession.
How does this?
Tom Lee says depression. That's an interesting word choice, Tom Lee. Okay.
Inflation call of yours and economic growth call is either influence or impact your call on crypto?
It has.
I really don't want China to fall into a depression either, because I smell WW3.
All very interrelated for you personally.
Yes, because crypto is dependent on monetary policy.
Right.
Right. So if inflation is cooling, then we can start to bet on forward financial conditions easing and central bank easing sooner. That's bullish for crypto. Or
right.
Alternative assets. Yeah.
Okay. So, but what I'm trying to understand is which view did you back into? Do you understand where I'm going with this?
I think crypto is the residual. Is the residual allocation based on what the central bank could do? And of course, Bitcoin separately has it as catalyst if an ETF, which, we're in the window where we'll start to see the potential for an SEC approval of a spot Bitcoin ETF.
And are you strictly Bitcoin at this point these days?
So I don't buy a lot of this. In regards to Bitcoin, it's pretty dang simple, right? Look at Bitcoin's year to date. Basically, Bitcoin acts as like a 2x to 3x leverage of the Qs or the NASDAQ in general. That's what I've always seen kind of throughout the, past many years since like Bitcoin really got on my radar, which is way back in like 2017, 2018 in a major way, right? And it just acts as, but on the flip side, if things get really bad, Bitcoin seems to get hit way harder than anything else gets hit. So if you're really bullish on the NASDAQ, I could see you being very bullish on Bitcoin, because I think Bitcoin will do very well in that environment, right? If you are in a situation where you think a major recession is coming, you think a major 20, 30, 40%, 50% drop is coming in the indexes over the next year or year and a half or whatever, Bitcoin's going to do far worse, in my opinion. it's just what happens. Like it's not like that's a crazy opinion to have. That's just literally what happens. Look at the past number of years. Look what happened in 2022 to Bitcoin, right? I mean, it was nasty.
I think it's still easiest to navigate through Bitcoin and Ethereum because of their regulatory status is a lot more clear, and even today's Coinbase announcement shows that those are the two ways to get liquid exposure to crypto.
Wasn't Bitcoin 60,000 plus, and then last year it fell to, gosh, where did it fall to? I think it was under 20,000. It didn't fall to like 15,000 or so. So that's the problem with Bitcoin is it's like, yeah, when things are roaring, it's great. And Bitcoin performs tremendous. But, man, when things get ugly, it gets more than ugly.
And I always like hearing your price targets because you are so fearless. Where are you on Bitcoin by the end of next year, let's say?
Well, if the spot Bitcoin gets approved,
yeah,
I think the demand will be greater than the daily supply of Bitcoin. And so the clearing price, this is done by Sean Farrell, who's our crypto digital strategist, is over 150,000. It could even be like 180,000.
But that's only if the ETF gets approved.
Yeah, and the U.S. a spot U.S. because a spot Bitcoin ETF is approved outside the U.S.
Okay, but if it's not approved, then are we just lingering around 29,000?
There's still upside counts because of the halvening next year. So you'll have a drop in supply again. So the clearing price has to increase, but it won't be six figures.
Yeah, much of it's going to really depend upon what state the economy's in, what state are investors in. Do they want to take risks at that given moment, or do they not want to take risks? That's what it really comes down to. Be patient in this market. Morgan Stanley's Chris Toomey says. Let's hear what he has to say.
Averages in August, the S&P now on track for its worst month since December. And our next guest says the most likely move for stocks from here is lower. Joining me now, Post 9, is Morgan Stanley's Chris Toomey. He runs one of the highest-rated private wealth advisory teams in the country. The more things change, the more they stay the same. I gave you the business a little bit last time because you're still negative in what was a pretty fierce rally. Right, we're a little rocky, a little edgy of late, as the word I've been using. And you haven't changed your view at all.
No, I mean, I think, like I said before, when the facts change, my opinion will change. I think right now we're really dealing with the fatigue of the move up higher, right? Like that was kind of a parabolic move higher. True. And now the market has to digest this giant move. And I think you could see that with earnings. So earnings were expected to be down. They weren't down as much, but they were still down. For companies that beat, the response wasn't as inspiring as you would typically expect, right? So you have that. You've got the seasonality of August and September typically being bad. And then you've got I
don't know where he sees these stocks that earnings are down. He must pay attention to a lot of different stocks than I pay attention to. Because I can tell you, most stocks I own or track, earnings are in a far better place right now than they were at this time last year. We're talking all the way from big dog companies like the Amazons and the Metas, all the way down to much, much smaller cap companies that were either losing crazy amounts of money, have cut those losses down in a substantial way, or flipped over to profitability. So, maybe speaking about energy or some of those sorts of stocks, right? Maybe, I don't know, a Tesla, Maesla, but I can tell you most stocks I track are in a far better place when it comes to their bottom line right now than they were last year.
Technicals, when you do one of those gigantic moves higher dramatically, there's usually typically a dramatic drop before you get some sort of stabilization. So I'd say part of what we're seeing right now is just fatigue.
I mean, digestion is normal. It's a normal process, right? And for sure you wouldn't see as bigger reactions from beats because a lot of the stocks I assume you're talking about had already run a lot into the numbers.
Right, and I think that was kind of my discussion the last time I was here. The market really was priced for perfection, right? We've got expectations with regards to earnings going pretty dramatically higher, right? The market's expecting about a 10 to 15% increase over the next 12 months, and we're also expecting 5 rate cuts in 2024. So, that's a lot of good things that are expected to happen. And so there isn't a lot that could go wrong that could tip this fairly negative.
No, but when you say, you'll change your...
See, this is what scares me a little bit in the market, I gotta be honest. Because a gentleman like this, right? He leans more bearish, obviously, right now in his tonality and kind of his thinking in the market, right? But yet you look at his 2024 earnings estimates, and they're actually substantially higher than this year, right? Now, that scares me. And the reason that scares me is this man's supposed to be more on the bearish side, yet he has S&P 500 earnings going up considerably next year, right? So that's where I start to begin to think like, wow, if the Fed lags were to really kick in next year, do you know what's going to happen to the stock market? It would be a very vicious sell-off. I mean, we're talking about a 25 to 45% type sell-off in the S&P 500 next year. If the Fed lags actually kicked in and actually hit the economy, because these folks that are more on the bearish side are expecting earnings to go up substantially next year. Never mind, obviously, what the bulls are expecting. So that means literally every single person would pretty much be caught off guard if the Fed lags actually kicked in next year and we actually had a recession at some point in the middle of the year, back half of the year, front half of the year, whatever, okay? That's scary. That's really, really scary. And that's one of the many reasons I'm just going to be hedged up. I will be hedged up going into 24. Because I look out there and I say, man, if these Fed lags kick in, ooh, baby, with all these bears that are expecting earnings to go up substantially next year, holy smokes. And then the bulls, I'm very happy to be somebody that's going to be going into next year hedged. Let's just put it that way.
And when the facts change, I mean, I could suggest to you, well, the facts have changed. The facts have changed since you were first negative in that we're further down the road on rate hikes, undeniably, closer to the end. And the economy is undeniably stronger than many thought it would be to this point, including the consumer hanging in. And as you said, it is, it's fact. And earnings have also remained better than people have feared. So aren't those strong enough facts that have changed?
So earnings are negative, right? So for the last 3 quarters, earnings have been negative. So they're down about 7% over that time period. If you look at the Magnificent Seven, which are driving the lion's share of this return, they're up over 70%, but over 63% of that is just PE expansion.
Multiple expansion.
Right? So in our minds, what's driving that? Is there a tremendous amount of growth that we're expecting? Are we expecting rates to go dramatically lower? Or the fact that the economy is actually doing better, right? And to your earlier comments with regards to no landing versus soft landing, if we get no landing, we know the Fed doesn't like that, right? Kashkari was out today saying we're not done. If the economy holds on and is continuing to go higher, we could be in a situation where the Fed is not looking at 5 rate cuts next year, but in a situation where it's not just like higher for longer, but maybe higher. I know, right?
But with all due respect to Neil Kashkari, does it really matter what he says today? Or anybody else for that matter on the Federal Reserve Open Committee?
No.
It just matters what they do.
Exactly. But I think the reasoning with regards to what they do is the fact that they are concerned in a situation where we had tremendous fiscal stimulus this year, right? We had a situation where the market has gone dramatically higher, and we're in a situation where the labor market is very tight. We're still at about 3.5% unemployment, right? And we're in a situation where core CPI is still above 4%, right? So in that environment, the Fed is not necessarily happy seeing the economy do dramatically better.
The other point you just made in terms of, is growth really going to be as good for some of the stocks that, you mentioned the Magnificent Seven. Yeah, it actually is. Aren't we learning that from some of the guidance that we're getting from the NVIDIAs of the world because of AI? That's the pushback on this idea.
Yeah, and something this gentleman's missing in a massive way in regards to 2023, the rest of this year, okay? Let's call it the back half of this year. We're looking at some of the biggest, most important companies' profitability skyrocketing. Not just going up a little bit, skyrocketing. Meta, Amazon, NVIDIA. Those are 3 very powerful stocks at profitability skyrocketing, right? Then you throw on top a Microsoft, who always is putting up very nice profitability numbers. Woo! I mean, yeah, those are very big, impactful companies that are massive market caps.
That, those stocks are way ahead of themselves.
I think the thing.
Google's earnings should show very nice growth in their bottom line for the back half of this year. Apple, I'm not so convinced of. They're the one lagger of the bunch, but just about everybody else in that space is, going to show extremely nice growth in profitability year over year.
What we need to think about is just because there's good fundamentals doesn't make it a good investment, right? At some point, price matters. And so is AI going to be a game changer with regards to the economy? Is it going to provide tremendous productivity? Absolutely. What are you paying for that right now? In my view is you're paying way too much.
Well, you're still paying less now than you were before. I mean, you don't have to comment on NVIDIA specifically, but that's sort of the perfect example of what you were paying 60 plus times a few months ago. You're paying 40 some odd times now, which for a stock like that isn't insane, or at least it hasn't been historically.
Historically, right? But that's also an environment where we had zero interest rates, right? So we're in a situation where cost of capital is now normalized. We're at over 5% in real rates. And we're in a situation where you don't necessarily need to be in a situation where you have to be in equities. And you can also discount that at a real reasonable rate and say, maybe I want to be in this when it's a little bit more attractive. So in our minds, I think there's more leaning towards the downside.
And to push back against that a little bit, an NVIDIA shareholder or investors doesn't really care about 5%, just to be quite frank. That matters much more for folks that are looking at dividend stocks, value stocks, things like that. But for NVIDIA shareholders or NVIDIA investors, people looking at that stock, they're worried about how do I make my next 50% over the next year, my next 30%, my next 100%.
Then the upside and sitting in cash collecting 5 or 6%. When the market in general has got a PE of 20, that's an earnings yield of about 5%. That's the same as the bond market right now.
Not everybody gets to see your every appearance and they remember everything you've said, nor for other people who have been cautious. So I just want to end with what turns you more positive? I mean, what has to happen?
So, I mean, look, I think what you have to think about is when you look at the market, right, what's priced into the market right now? And right now you're expecting higher earnings and you're expecting lower rates. And so when the market is in a situation where it's not necessarily priced for perfection, that's when I would say this is a good opportunity to get in. So if in my view, you have maybe one of three things. Either our expectation that growth is going to be higher than what the market's pricing in, which we don't necessarily think.
6 to 9 months from now, you don't think that?
I think it's already priced into the market right now. What the market's pricing in is very aggressive growth rates. And so in my mind, unless I view that the market's underrating that growth, I don't want to necessarily add exposure. Or if the market thinks we're going to be in a situation where rates are going to go dramatically lower, then I would say, okay, now's the time to be in the market. The other thing is one of those macro situations. You get a resolution with regards to Russia-Ukraine, you get a China resolution, something that's not necessarily something that the market's pricing in right now. Otherwise, just be patient.
Well, you run one of the highest rated private wealth advisors.
Yeah, good points. One last thing I want to leave everybody with here that I think is important, right? Because still, there's a sentiment or excitement about, when the Fed starts cutting rates, right? But one thing I just want to remind everybody of, I think this is extremely important. Usually when the Fed's cutting rates, it's usually because things are going bad, okay? They usually don't just cut rates to cut rates. So do keep in mind, if the Fed starts cutting rates at some point in 2024, it could definitely, high probability be, not 100% for sure, but that's a high probability. It could be because the economy is starting to go into recession at some point in time. Maybe job loss are starting to hit. Things are starting to look ugly. So it's not 100% for sure, but more than likely, that's the situation. So don't just run to the assumption Fed cut rate, stock market booms. They were cutting rates in, a whole lot, okay, and down to zero. And look what happened to the market. It went down like Robert De Niro in Last Action Hero. He wasn't in that movie. I appreciate everybody joining me. As always, thanks so much for being here, folks. Make sure you check out pinned comment down there if you want to apply to join my private group with myself, the 6- and 7-figure members, and all those sorts of things. Much love and have a great day.